It's time for In the Money, stock market action on AM 820 News. Here's Chief Market Strategist Gareth Soloway from InTheMoneyStocks.com.
Good afternoon, everyone. Another Sunday and another profit-making opportunity here at In the Money Stock Market Action on 820 AM News Talk Radio. I'm here not only to reveal Wall Street secrets, which I've been doing for well over a month now, but I'm also here to give you the trade alerts, which I've also been doing, and strip away all the nonsense and thus make you money. And I think that's the moral of today's kind of action that I want to give you guys. Not only talk about what Wall Street's doing out there, but just continue on our hot streak of calling the markets with really an unparalleled performance out there. And those of you that have been taking some of these calls are doing very, very well here in 2014, kind of printing money. It's kind of fun to be almost like the Federal Reserve, where the Fed can just print money, but if you know what you're doing in the stock market, you can also pretty much just print money. And that's what I always joke about to my members at InTheMoneyStocks.com about how we can almost be the Federal Reserve. We just do it a lot more ethically. We're in there and reading charts and using our expertise as opposed to just pressing a button on a keyboard and all of a sudden magically another $1 trillion appears. So in any case, Wall Street wants you to be ill-informed. They want to keep you emotional. All right, and emotion is one of the biggest kind of negatives that the average investor has to deal with, and Wall Street is preying on that. And I want to discuss a little bit about that today, folks. So we're going to look into emotion and how, generally in your life, it's not a bad thing to have, but when you're dealing with investments and making rash decisions, it actually can be a big, big negative. And Wall Street, believe it or not, knows it. And they do things on purpose to push you in directions to make those rash, emotional decisions. All right, so I'm here to try to help you to stop that. I'm here to enlighten you and get you on the right path to financial freedom and profits. Okay? For far too long, investors have been the butt of the joke, a way to line the pockets of Wall Street fat cats. All right? If you're listening now, you're making the decision to stop that nonsense, to step up and fight for equality in investing. And really, that's what we're just asking for, right? I'm here before you to say, listen, it's an unfair playing field. And it just is. I mean, institutions have computer programs that are trading 100 times between the times you and I can press a button on a keyboard. All right, they're getting news and they're paying for news a millisecond before you and I are going to get that. All right, they generally know when big buyouts of companies are going to come, and you can see it in the options action prior to that buyout where there's a spike in call activity. All right, so all I'm coming to you to say is, listen, we just want to even that playing field, and I'm going to do my best to allow you to do that, to give you the information so you can even it, so you can understand what's going on behind the scenes. And that's all we need to do. All right, I'm not going to sit here before you and tell you, oh, we're going to change the system. All right, the system has always been where those with more information are going to make more money. The key is, can you even the playing field so everyone has that information? And once you have the information, then you just make an honest, logical decision. And that's all you have to do. And then all of a sudden, oh, look, a profit there, money there. All of a sudden, you stop giving your money away to these bigger players out there who are just continuing to make billions of dollars. I mean, I just remember over the last couple quarters, these big institutions always report their trading profits. And it always blew my mind. And I'm a trader, and I'm also a swing trader. And day trader is where I'm day trading intraday. So I'm day trading, I'm buying something and I sell it the same day. I just look for small little moves in stocks, taking advantage of, a 10-cent move here, a 15-cent move here. But if you buy 1,000, 5,000 shares, you can make a little bit of money throughout the day. And that's what I like to do. I also am a swing trader. And as a swing trader, I, buy a stock for a couple weeks looking for the bigger move, make 10% on an investment and move out. But these institutions, they report their trading profits, and it always amazes me because at the end of a quarter, meaning every trading day of the quarter, some of these banks never have a losing day. And that just screams to you. Listen, if someone were to come to me and says, hey, I'm a trader and I never have a losing day, I would honestly call them a liar. It just would be the way it was. So to see that they're able to generate that, it tells you that they do have the upper hand. And we all need to understand that. And all they're doing is really taking advantage of the average investor, the average trader, not knowing any better. All right, they're using certain things like emotion against you. So let's make sure we even that playing field, and all we have to do is educate ourselves. That's all it really is, folks. You don't have to be scared of the markets. You don't have to say, oh, no, it's the boogeyman out there. All you have to do is say, listen, let me just learn a little bit about this. And when I do, I can then start making money and not allow the institutions to just take it so easily from me. All right, so welcome aboard to In the Money Stock Market Action. First off, let me give out the call-in number. If you have a question on trading, if you have a question on a stock, if you have a question on manipulation in the markets and how to kind of get around it, give us a call here at 866-977-4820. That's 866-977-4820. All right, folks. In today's show, a couple things I want to go over as well. We're going to talk about last week's market action. I thought it was amazingly important. Certain things in that action were of the utmost importance in relation to where this market is going. I saw some parallels between early January that continue to put me in a very bearish mode. And I just want to make something clear about that as well. I'm never a perma-bull, perma-bear. What is a perma-bull, perma-bear? Well, a perma-bull or bear means that you're always bearish or you're always bullish no matter what. All I do is I roll with the markets. So if you remember in early January when I first began this show in the Money Stock Market Action, I was very bearish on the markets. And the markets collapsed in a couple weeks, 5%, 6%, 7%. And then all of a sudden I was giving out long trades to you guys when we were down 5, 6, 7%, when everyone else out there was bearish. Everyone was, oh no, the sky's falling. This is going to be the big 20% correction. And I came out and I gave you long opportunities. And you know what? We made money on those. And as the market has rallied now, I've started to give out more bearish calls again. All right, and bearish calls meaning short calls. Shorting is where you make money when the stock goes down or a market goes down. So I just want to really make that clear is that I don't want any of you guys to ever be perma this or perma that. You never want to be always one thing or the other. You have to be able to look at the market and just strip out that emotion again, which is what I did at the market lows in late January, early February, and say, all right, well, based on the technicals of this chart, and I look at charts a lot. You know, I look at a stock trading up and then trading down, and I can see things in the chart, which I can teach each and every one of you, where it tells me precisely with a high percentage of accuracy where that is going to go. All right, and that's what I would like to teach you guys over the course of the coming months as well, although it takes a little bit more time, and also you want to see the chart. So oftentimes I would recommend going to InTheMoneyStocks.com. That's InTheMoneyStocks.com, my website, where I have a partner, Chief Market Strategist Nicholas Santiago. He was on with us a couple weeks ago. And there you can really learn, and you'll see our charts live and so forth as we point things out. All right. We also have a free trial, just to make it clear, so you don't even have to pay. You can just take the free trial and check us out there at InTheMoneyStocks.com. All right, couple things other that I would like to go into here. First of all, we want to go over a couple impressive articles this week. This was the first week in forever, I feel like, that I saw other people writing about the manipulation of Wall Street. And it made me happy, honestly, because I don't know if I'm having an impact out there or if other people are just starting to stand up and have the guts to stand up and kind of say, hey, listen, this is going on, and letting the average investor read about it so they can become more informed. But I want to talk a little bit about some of those articles a little bit later. I also want to go over the new trade alerts for the coming week. All right, if you recall, last week I gave out trade alerts that were going to be valid not just through the 4-day week we were just in, but through the coming week as well. And I have a couple additions to that. We're also going to take a couple profits off the table, as a couple of those stocks from last Sunday's show had great gains, absolutely great gains. One was Sugar, which was just a phenomenal gain in 4 days, up 7.5%. All right, there's no one else doing that stuff, folks. All right, I don't even care if you're a hedge fund out there. You're not being able to call type moves like that in 4 days. And we're doing it right here on In the Money Stock Market Action, this radio show, which is coming to you live every Sunday. Every Sunday. Okay, let's talk a little bit briefly about last week. Because last week in the markets was kind of a weird week. The markets didn't end that much to the upside. They didn't end that much to the downside. They were kind of around the flat line. And I just want to go over each individual day because there are certain key points I want to make. All right, number one, Tuesday was our first trading day after the holiday on Monday, and it was what we call a hangover day. And a hangover day, it kind of comes from the whole hangover of drinking a little too much. The market after a holiday is oftentimes very quiet. All right, why? Well, because a lot of the traders out there are taking a little extra time with their families. You know, maybe they did party too hard over the weekend as well, and they're just slower moving. So there's not as much volume in the market. Okay, and generally, when there's not much volume in the markets will go higher. Because, again, if there's no volume from the institutional people, which we know are sellers these days, well, then the little guy, the mom and pop, they're buyers, and the market on little light volume floats up. The mentality is generally positive these days, so you're going to see an upside gain. Well, interestingly enough, on Tuesday, in extremely light hangover volume, we didn't see much upside. The markets basically ended flat on the day, and that was kind of a heads up to me. I said to myself, listen, what's going on here? There must be something at work. So that was the first kind of heads up that maybe we'd see some interesting action the rest of the week. On Wednesday, All right, the markets gapped lower. All right, we had a little bit of panic reemerging. Markets gapped lower in the morning. Gapping means you opened lower. And all of a sudden, we saw a buy-the-dip mentality. All right, well, what's buy-the-dip mentality? Buy-the-dip mentality is where we see the markets gapping down, and then everyone just rushes in. Mom and pops say, oh, this is a cheap way to get in the market because I just know it's going higher. And that's exactly what the institutions want you to think, by the way. But it's working like a charm. The average mom and pop, the average investor out there is just buying hook, line, and sinker. And, every little 1% pullback's a buying opportunity because that's the way they've been programmed for the last year, 2 years, 3 years, 4 years. And sure enough, the markets came up. And this is where it got interesting, okay? Because the markets came up with the SPY, which is the tracking ETF, went exactly to the penny to the high from January 15th, which was the all-time high. The second it hit that high, it backed off immediately and sold off. And then at 2 o'clock, we got the Fed minutes, and we got some key things out there. So we got some key information, including the IMF saying that global growth wasn't going to be as robust. A Fed president came out and said we might be raising interest rates by 2015, which is important because it tells us that QE will be 100% done by that point if they're going to actually be raising interest rates. And the markets, again, went exactly to that high and then backed right off. All right, next on Thursday, the markets reversed back to the upside. So you saw a buy-the-dip mentality. After Wednesday's sharp down day, the markets came right back. Buy the dip, mom and pop. Here it is. Here's a little bit of a discount. Buy in. And again, guys, I'm being somewhat sarcastic there because I really need those of you that are investors to understand that that's not the way you behave. You can't let the big institutions program your brain, all right, like a computer and just, buy, because what you're doing is you're buying and they're selling right into you. But that's what happened on Thursday. Markets rallied right up again on Thursday. And interestingly enough, this is important. We rallied up, but did not close above a 100% negation of Wednesday's down day. Okay? So that was interesting in and of itself. And then just to go into Friday, the markets popped early, but we couldn't take out Wednesday's high again. So you made a lower high. So all these signals to me are pointing about distribution. And we're going to take a quick little break here. But when we get back, I want to talk more about distribution and what is going on in this market. All right. So again, this is In the Money Stock Market Action. My name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. And this is 820 AM News Talk Radio.
Here's Gareth Soloway with more In the Money Stock Market Action on AM 820 News.
Welcome back, everybody. Just a reminder, if you have a question or if you have some sort of issue you'd like to discuss in relation to the markets, feel free to call in 866-977-4820. I'm always here to do my best to help the average investors kind of navigate through this wild market. Now, just going back to last week's action, I just want to finish up on a couple key points. So the big pop-outs for me on the last week action that kind of make big exclamation points. Number one, all right, we had that dip on Wednesday, right? So we had the reversal on Wednesday after hitting the exact high on the SPY, which is the tracking ETF, and that's the all-time high. So imagine that market, right? And it goes up exactly to that high, but it can't push through by even a penny or two. It hits that and immediately starts to sell. That has to be a little bit of a signal, right? So in other words, it didn't have the strength to even peak above that high and then reversed. Then on Thursday, we saw the market rally back, which was great. All right, nice rally back. All right, everyone on Wall Street, everyone in the media was all giddy again. Oh, this is good. This is great. The market can rally back. But we didn't negate Wednesday's down move. It came within pennies, but couldn't do it. To me, another negative signal, another weak signal. And then Friday, the markets early in the day popped up, coming just underneath Wednesday's high. So again, we couldn't even take out that Wednesday double top high even by a penny. It didn't even get there this time, as opposed to Wednesday where it hit exactly to the penny. Couldn't even get there on Friday. And then again, we reversed and we actually closed to the downside. On Friday's action, the S&P closed down 3.5 points, the Dow down 30, and the NASDAQ down 4. And again, it wasn't a big down day, but it's kind of reading between the lines. That's what I'm doing here. And this same price action I was seeing in early January, up to about January 15th, 16th, 17th, in that period before we got that little bit of a sell-off. Now, I will say this. If by chance the markets this coming week can pop, and listen, we're just less than 1% away or about 1% away from the all-time highs. We're still kind of right up there. But if the market by chance can push above those all-time highs and actually close well, then you might get a little bit of upside. It would be very minor upside. I wouldn't all of a sudden go bullish on the markets, but it would just tell me that, okay, they got it through that level. It's almost like a door, right? And imagine you're a I don't know, a workman of sorts, or you're a firefighter, right? And you're there's a fire in the door or behind the door in the room, and you got to get in that room, and you're banging against that door as hard as you can with your shoulder, kind of trying to ram it down to get to the people behind that door. All right, that's what the market. That's the analogy that I would use for this market, where it's hammering on that level but can't get through. The door is a very sturdy door. Now, if by chance it can bust through that door, well, then you have a little bit of upside. It can go into the room and save people and everything like that. But always kind of put those analogies to the market, and I think that helps most people understand exactly what's going on here. But right now, the door is holding firm. You can't get in. They're not letting you get in. Now, what's going on there? What's creating that resistance point? Well, very simply, it's distribution. Same thing we saw in early January. Institutions are in sell mode right now. All right, they are absolutely in sell mode, and sure enough, as individual mom and pops and investors buy, they're just saying, here it is, here's the selling. So that's what's creating that kind of inability for it to break through. Now, if institutions were on the other side, right, let's take it from the other perspective. If institutions were buyers, all right, now remember, institutions have hundreds of billions, if not trillions of dollars at their disposal, right? And if mom and pops and you and I's were selling at that high, do we think it would get through? Well, sure it would, because you have billions, hundreds of billions, maybe trillions of dollars buying the market, and only, I mean, how much does the average investor, even combined, have in total? A lot less. So you see what I'm saying, how if you look at it in terms of that, you can actually see the reason why the market's having so much trouble there. It's because the institutions are selling. And that brings me to an article that I saw on, I think it was Market Watch by William Watts, and it was just kind of showing us, and some of you guys may say, well, again, I want more proof that the institutions are selling and so forth. Well, here's an independent article that basically says just that. And the title, Scary, shows mom and pops running into the market full force by William Watts. Investors, including mom and pops, came running back to the market after its late January, early February stumble, with data on investment inflows showing that risk appetite is once again on the rise. All right, and it goes on to talk about the amount of money being put in. But bottom line, folks, is that this is happening as we speak. The average investor is running into this market because they've been programmed to do just that. And when it all comes down to it, we have to be aware of that so we can combat it. Because really what's going to end up happening is even if the market breaks to the upside just a little bit, it's going to ultimately come down. All right, the institutions, they're not stupid, right? I mean, they might be a little shady. They might do unethical things. They might have be one of the big results for the collapse, the financial collapse in the 2007, 8, 9 period. But bottom line is, they're usually on the right side, and if not, they're going to get bailed out. And if they're net sellers of the market, we all need to take notice. This isn't something you can kind of go back to sleep and say, all right, whatever, so big deal, the institutions are selling. No, you need to take notice. All right, this is huge. And I said it last week, and I'll say it again this week. And by the way, we'll go over the trades from last week as well in a second. But bottom line is, the markets are setting up for something. All right, and I don't know if it's going to be a 3-4% pullback and then another 2% bounce, or a 5%, 7% pullback and a 5% bounce. You're going to see continued buy the dip because the average investor has been programmed to do that. Now, I want you to be not average. You should be amazing. You should be on the top of your game, and that's why you shouldn't be getting caught in this nonsense anymore. And I would honestly, if someone asked me, what do I do? I'm invested in the market. I would be right there. I would say start unloading into the buyers. Be with the institutions. Always be on their side. All right? They're going to 99% of the time be right, while the average investor will be 99% of the time wrong. All right, it's just the nature of the beast, guys. It's the game. It's the game that we play. And the game is a term that I've started to talk more and more about to you guys, and I'm going to use that term a lot in the coming months. And the game is the institutions manipulating what they have the ability to manipulate, which is ultimately your emotion, to get on the wrong side of the trade. They need you always to be buyers when they want to sell because they need someone to sell to. And they all need you to be sellers when they're buyers. And the institutions, which make billions every quarter, they're obviously going to be right 99% of the time. I mean, that's why they're making historically billions of dollars over the quarter. So remember that, okay? Now, the game, again, just to briefly go over it here, is simple. The institutions, through analysts, which they control, And the media, which they don't necessarily control, but can portray and get the analysts to pump things and the media to pump whatever they want when they're running stocks up and down, they are swaying the emotion of the yous and me's. And this is something that I've learned to control very well, but you all need to do it. All right, and so imagine you have analysts upgrading stocks, downgrading stocks, upgrading at all-time highs like Apple 2012, Twitter with $75 just recently. That's what analysts are doing. And the institutions are enjoying that because it's getting more mom and pops to buy into Twitters or at Apple's at 700s. And ultimately, the media then plays into the game by continuing to just go nuts and talk about these things, which creates an emotional response in the average investor. And then from that point, the average investor reacts. And the average investor, when they think that it's easy money to buy Apple at 700, are going to buy Apple at 700. All right, maybe they only can buy 100 shares, but obviously you get 1 million people to buy 100 shares, and it's a lot of shares of Apple there. Okay, so think about it. Understand the game. Once you understand the game, you can negate the game. You can put it on an even playing field. All right, just briefly, before we get into our little break here coming up, I want to go over the trades from last week. I called out the S&P 500 short at 1838.63, and it closed down about 2.5 points, so that's a check plus right there. SGG, which was your sugar ETF, long at 52.67. It closed at 56.63. That was a 7.5% gain, or about $4 gain. Corn, CORN, 31.49. Closing at 31.88. That's a 39-cent gain. The Qs ended up being flat, and the VXX up 2.5%. All right, so we're going to take a little bit of a breather here, and we'll be back shortly, folks. But again, bottom line is, when it all comes down to it, you need to understand exactly what's going on out there. And these trade alerts I'm giving you are gold. All right, I'm not going to be perfect. There's going to be a loser here and there. But I want you guys to start understanding why I'm bringing you these picks. Why am I giving you this information? Why am I so accurate on my calls? Well, because I'm going the opposite way of the average investor. I'm using the game, I understand the game, and I'm able to profit in the game. All right. On that note, folks, we're going to just take a breather here. One more time, my name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com, and you are listening to In the Money Stock Market Action on 820 AM News Talk Radio. We'll be right back.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
All right, guys, back on here in the Money Stock Market Action. My name Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. And again, the call-in number, 866-977-4820. If you have a question, a comment, anything about a stock, feel free to give us a buzz here, and I will do my best to help you understand and profit. All right. Now, just going back to the picks from last week, the trade alerts that I gave you last week, again, phenomenal result. There was one of the picks that was down slightly, which was the Qs short, which was down a total, get this, of 12 cents. And it was an $89, $90 ETF tracking the NASDAQ 100, and that's the QQQ. Aside from that, the VXX up over $1 or 2.53%. SGG 7.5% gain, almost $4. Corn, CORN, which we've been in for quite a while now, up another 1%. And the S&P 500 short, which was down about 2.5%, which is in the money. Remember, when it falls, that's what we want. So it ultimately gained 2.5 points on that trade alert. And again, that's in 4 trading days, folks. Think about that. I mean, here you have even institutions and hedge funds having longer-term periods where they're focusing on the market and saying, over the next year, let's try to make 10% on this one investment. Well, 4 days, 7.5% right there, SGG. All right, now, what I told you guys last week is because it was a short week, we were going to give these an extra week to play out, but there are a couple that we have to take off the table. When something gives me a lot of profits, I don't literally look at it and say, I'm greedy, I want more. That's one of the biggest errors an average investor makes. All right, I don't care if you make $1 on a stock or $1 million on a stock. The point is, you always want to take a profit. All right, the big saying in the industry, in the trading industry, is no one went broke taking a profit, right? And that's the truth. I mean, even if you're taking $10 a trade, I mean, technically you're still making money on every trade. You do 1 million of those trades, you've made a lot of money. So the biggest error, again, that I want to discourage you guys from making is being up significantly on a trade and still saying, oh, well, I think it's going higher. Well, you know what? I hate to break it to you, but what you and I think doesn't matter a whole lot. It really doesn't. The market's going to do what it's going to do, and the way I get around that is by looking at the charts. All right, if I look at the charts, I can literally tell when a stock has mostly maxed out the gain or not. And in this case, with SGG, I still think it has a little potential upside, but the risk-reward, and this is big, understanding risk-reward. How much reward is there to still be in SGG after it's already bounced from $50 to about 56, 57? Honestly, there's not that much. Could it go to maybe 60? Sure, but you know what? It could easily fall back to 52. And now that's where risk-reward has to come into play. And I say, listen, it's just not worth it. So what we're going to do is we're going to take SGG off the table. All right, pull that one, and I'll replace it with a trade a little bit later, a new trade. But we want to take our profits on that one. Let's not be greedy. Let's be smart investors here, smart traders, and pull that off the table. The other one I'm going to pull off the table is corn as well, CORN. You guys know, really since January we've been in this, and every week pretty much we've just been making 1%, 2%, just steady, 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 which is great. I mean, I have no problem with that as long as the risk-reward is matching up, as long as the charts are telling me it's going to continue up. But again, on this one, risk-reward just isn't there anymore for me. Yes, it could have a little bit more upside, but it doesn't warrant the risk of giving back the profits that we've had. So we're going to pull off CORN as well, okay? So both nice gainers, especially corn over the longer term and shorter term SGG. I think we held SGG for 2 consecutive weeks there, making quite a bit of money. I think as much as 15 to 20% in total. Or thereabouts in just 2 weeks, another 7.5% here. But those are off the table, and I'll replace them with 2 trades later on. We're going to continue to hold the S&P short. I still think this market, at least from the signs that I'm seeing, it has no reason to be up here aside from the small investor buying, which is so sad. I mean, if you think about that, I wish I could reach everyone in the U.S. I wish I could reach everyone in the world and just, explain to them that you don't want to necessarily be buying the market at all-time highs. It's just not smart. I mean, just think about that. I use this analogy all the time, and I think I've said it to you guys a few weeks ago. But, if you go to the mall, all right, what do we do when we go to the mall? Well, we go there to buy a pair of jeans or a shirt or whatever we might want to buy, but we're always looking for a sale, right? I mean, I don't go into the mall and I look for the shirts that were marked up 300%. All right, no. I mean, that's ludicrous. Why would I want the shirt that was, $25 or $100 last week and is now $500? I mean, that doesn't make sense. So we need to treat investing the same way. Now, why don't investors treat investing the same way? Because you've been brainwashed by the institutions, by the big banks, by the big Wall Street fat cats out there. You've been taught that, hey, listen, the smart people on Wall Street, well, they're on TV and they're telling me the market could still go higher. And they're getting me all riled up because I wasn't in the market, last month. And now I've missed a huge amount of gains. But, man, they're just saying it's going to go higher. I don't want to miss it. They're making me feel horrible that I missed it before. So let me get in the markets now. Wrong. Error. Major error. Red alert. Whatever you want to say. All right, that is not what you do. Treat investing like going to the supermarket and look for the sales, or the mall looking for the sales. All right, when I go into the mall, I'm looking for that pair of jeans on sale. Just like when I go into the market, I'm looking for a stock that's on sale. All right, and a stock that's up 100% in the last year is not on sale, folks. Hate to break it to you. It's not on sale. And any of you that have invested money, look back at your past investments over the last year and ask yourself that. All right, now, it's not to say you can't get a little bit of upside out of it, but it's all calculated risk-reward. We always have to be looking at that. And what's one of the big things I impress upon my day traders and swing traders at InTheMoneyStocks.com, I always talk about, listen, yes, that stock has a little bit of upside potential. Sure, it's a nice pattern. The 200 MA is $1 higher. But what's your downside? Always look at your negative. All right, what I do as a trader, I look at my negative first, because what ends up happening is that if that negative pops out at me, I won't even look at the positive because I'll cross it right off my list. All right, so again, think about a trade like this. Yes, a trade could go up on my, let's say, XYZ swing trade long or Microsoft swing trade long, and again, that's going long. That means you buy it. Let's say there's upside on that stock for $1. Okay, so I can make $1 on that. That sounds pretty good. Now, the average investor looks at that first and says, oh, yeah, I can make $1, and I just know it's going to go there, so I'm going to buy it. What they're not doing is they're not looking at their downside risk. And if you look at the chart and the downside shows you that it could drop $3, well, that changes the equation. So wait, So I could make $1 on Microsoft on the upside, but I'm risking $3 to the downside. Now ask yourself this: does that make sense? I don't think so. I mean, why would you risk $1 gain to lose $3 if you're wrong? I mean, now if it was reversed, if I could make $3 on Microsoft and I could only lose $1, well, now it's an interesting risk-reward proposition, especially when you have price pattern time formations, which are the three things you need to look at. And price pattern time is what we factor in the charts when we make calls, my partner and I, at InTheMoneyStocks.com. We're just looking at price pattern time. It's called the PPT strategies or PPT methodology. And it's very simple. You're just analyzing time, which is super easy to look at on the chart, price, simple, and pattern. And basically the pattern is on the chart. Is it making what we call a bull flag or a bear flag? Or these are terms that you might not be too familiar with, but over time I'm hopeful that I can explain it fully. And if you want to, again, come to InTheMoneyStocks.com, take the 7-day free trial. You can always check it out there. Okay? But just by looking at those three things, I can make a split-second decision and be right literally 80% of the time. And that's why, if you notice, I'm giving you 5 calls. And this is funny, guys. I'm giving you 5 calls every week pretty much. And I'm basically flat to slightly negative on one of them. The rest of them are winners. And that's about 80%, right? So, just little things like that we have to pay attention to and understand. And if you can gain that knowledge, you basically become that percentage trader where you're going to be competing and beating the hedge funds. All right, there aren't 8 hedge funds out there that are really doing 80% or more. All right, the institutions, yeah, the biggest players with the high-frequency trading platforms, they might be able to kind of outperform because they're getting the news a split second before everyone else. I mean, but if you took that away from them, we'd be knocking them out of the park. I mean, there's no doubt about it. And again, listen, that's the one side of the coin I wish that regulation would kind of clamp down on a little bit more. And it is starting to, because there's a little bit more awareness of it. But, for instance, there should be more prosecutions. All right, you have these institutions that are getting positions on puts and calls and making thousands of percentage gains just on buyouts, getting the information ahead of time. And again, those are very hard to prove because they can do it through certain layers. You have the high-frequency trading programs, which are really just flipping for pennies here and there, but they're able to kind of sway the average trader and just take their money intraday. And then you have other situations as well, like, we just discussed getting the news a split second before everyone else. Those types of situations are not okay, and that ethically is something that hopefully the government will clamp down on at some point, although, again, the lobbyists will probably never allow that, which is just another sad situation. But what we can do is we can just compete by looking at the charts and looking at the PPT methodology, price, pattern, and time, and simply just say, all right, well, price is right here. That's good. Pattern, good. Bull flag. And time, ooh, look at time count. And a time count is something significant that we've discovered. These are all proprietary techniques that we teach to our members. But when you have these aligning, you put yourself in an unbelievable kind of setup for profits. And again, that's why, these trade alerts, some of you guys might be scratching your head, not sure how I'm calling these out, just giving them out for free on the radio. Well, I'm doing it to kind of show you guys that you can be on a level playing field. You can do your best to make money, and you can actually make money in the markets. And that's in an up or down market. It doesn't matter whether it's a down market. Who cares? You go short. All right, now some of you guys might not be familiar with what shorting is. Well, shorting is just, basically in your account when you go short, you would see a negative 100 shares instead of a positive 100 shares, which means as the stock falls, you make money instead of it going up. All right, if it goes up, you lose money. If it goes down, you make money. And it just appears in your account with a negative in front of it as a negative 100 shares instead of just a even 100 shares. Okay? And some people have come to me and they've said, I don't know if it's ethical to short. I don't know if it's okay to, be on the downside and be kind of rooting for the downside of the market. And I guess to some extent, I kind of understand where that mentality is coming from, but it saddens me because the institutions have really programmed you to feel that way. All right, just like a wave. A wave comes up, it comes down. It comes in on the shore, it goes out. All right, investments are always going to go up or down. All right, by the institutions programming you to just say, oh, well, that's not ethical. I shouldn't do that. Well, they're doing it. They're the ones that are setting themselves up, so they just take your money when they get you all along and none of you guys are willing to short the market. Then they just pound it down, and then eventually you sell for a loss, and you just sit out until the market gets back to all-time highs and buy again. I mean, these guys are doing it. All right, and it's silly to handicap yourself. I mean, that's like trying to play a sport, right? Soccer or football or whatever. Imagine tying one hand behind your back and your feet together. All right, now go play a sport. And that's what you're doing to yourself. All right, there's nothing wrong with if a stock is going to come back because the economy is slowing down with just making some money on that direction. Why not? And again, boggles my mind. It's funny. I got an email over the weekend from a member actually who was asking me and said, I ethically, it's hard for me to short, and really what happened was I lost money on some shorts back in the day, so now I'm just going to say it's ethically wrong. I scratched my head. I couldn't believe it. I could not believe it, folks. So basically, what this member was telling me is that they shorted in the past when they weren't with us, when they weren't with InTheMoneyStocks.com, and they got hammered on it because they didn't know what they were doing, and now they're claiming it's unethical reasons, but we all know it's not. But the point is, if you do it right, it can make you money. And listen, there's enough disparity in the global picture in the U.S. between incomes, with the top 1% of these bankers, these fat cat Wall Street players, just literally making billions of dollars, that you don't have the luxury anymore. I hate to break it to everyone. You don't have the luxury to sit back and just say, oh, well, whatever. I'm just going to be long the market. I don't feel like it's a good thing to short the market. Wrong. You got to do it. I mean, if you're not going to, then be prepared to stay in the income brackets you're in and just let these guys get more and more money. It's time to step up and really pay attention. And this is part of investing. It is. If you're not willing to short, honestly, you shouldn't be investing at all because you just continue to lose your money. Flat out. Just being honest. Okay? Sorry to get riled up about it. But it drives me nuts. It drives me nuts. It's every single investor out there should be making money on the up moves in the market and on the down moves. And if there was just equal opportunity, if there was equal knowledge out there, which I'm trying to give you, then I think you could do it. All right? And listen, when it all comes down to it, you have the ability. If you want to keep your head in the sand, do so at your own risk. But you have the ability to make lots of money out there in any economy. Even when the markets were collapsing in 2008 and 9, there was so much money to be made as we made it in InTheMoneyStocks.com. And our members could retire faster as opposed to most people who listened to the Wall Street fat cats and just stayed long in that whole collapse. Well, they had to postpone retirement. And now the setup is starting all again. It's like, I swear, it's like the movie Groundhog Day. It really is. It's like Groundhog Day. So let's take a quick break here, guys. Let's get going here. I'll be back. We'll get our new trade setups for the coming week. We'll discuss a little bit more. But just one more time, my name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. And this is In the Money Stock Market Action on 820 AM News Talk Radio.
Here's Gareth Soloway with more In the Money Stock Market Action on AM 820 News.
Welcome back, guys. Final segment of the show today, and we have a lot to cover. Excited to get back into it. Let's get through everything we can today. All right. Number one, I'm going to go over a interesting article. It's the second one I wanted to go over today in respect to kind of the beginnings of what I'm seeing of general media outlets starting to catch on that the average investor is clamoring for more information and kind of the inequality that there is on Wall Street when it comes to information and kind of the game as I talked about earlier on. So this article was on Market Watch, which is it's a nice website for market information, and it was by Paul B. Farrell. And it was titled, The 10 Weapons Wall Street Uses to Manipulate You. And I saw this week, and I was just giddy. I was so happy. I was like, all right, yes, finally others coming out and starting to kind of speak up. And I just hope enough investors read these type of articles and at least start to understand the game, as I said earlier on. All right, listen, in essence, if you understand the game, you're going to be on essentially an even playing field, at least a playing field where you can make money. Okay, because you become part of the ones in the know, the investors in the know, and by knowing, you put yourself on the right side of the trade, basically with the institutions. I mean, that's all you're trying to do is you just want to be, when they're sellers, net sellers, you want to be net sellers. When they're buyers, you want to be net buyers. And you'll notice that in 2009 at the market lows when everyone was panicking, guess what they were doing? They were buying like crazy. If you look at the volume, and remember I talked about volume earlier on, how the market recently we're seeing very light volume as the market is kind of in that buy the dip mode as the mom and pops, which don't have as much money even combined, are buying, but the institutions are not. These type of things are important. So just let me read through a couple of these points out of the 10 that he brought to the attention. And I agree, and I've said them to you guys before. All right, number one, hire psychologists, neuroscientists to manipulate the media. All right, they're using consulting contracts, grants, and retainers and lock up the best talents to work for them to go against the 95 million individual investors who are irrational and uninformed. All right, so basically what this is saying is that these big banks, these big institutions have money. They have huge amounts of money, and they're hiring the best psychologists and neuroscientists to basically create a manipulation of the data out there. So these guys are going to be reading the market sentiment. They're going to be reading how to manipulate the media. And I talked about that earlier on, how when the markets get higher and higher on it, they can, let's say the markets are rallying up ridiculous amounts. They can actually create that buzz in the media, which will then be translated to the average investor. All right. Number 2, free experts constantly deliver Wall Street's messages to the media. All right, so this is another big one I've talked about. All right, so how you have the analysts out there who are paid by the institutions in many cases, but then you have just analysts who come on CNBC and some of these other, Fox Business and Bloomberg and so forth, and they're just basically going to tell you what the markets are doing and try to position you accordingly. And they're being manipulated into saying, oh, this is a great market. It should go higher. This is what the market's doing, so I'm a buyer here. And, well, of course, the average mom and pop are going to listen to that and say, oh, well, if, John Smith guru out there is saying to go long and this market should go up, well, I'm going to be a buyer too. And it's just creating that kind of snowball effect that goes into the average investor marketplace there. All right, they invest mega bucks on lobbyists to control politicians and government. Listen, this is one of the biggest things, and it goes far beyond the investing world. I mean, this goes into the drugs and pharmaceuticals. I mean, and keeping certain things off the market that they don't want coming out. And I mean, this is one of the biggest issues with our government. I'm sure many of you will agree. The whole lobbyist side of it. I mean, no reason why you can't get rid of that again. I know it was said okay a while back, but I honestly think it's messed things up hugely. I mean, when you have big corporations with agendas that are able to push millions of dollars into a campaign as a lobbyist or do whatever they're able to do there, there's obviously going to be an impact which is going to be swayed towards that institution or that big firm getting their way. And who's the getting the short end of the stick? I mean, well, you and I and every average American out there. So, I mean, I think that's a huge issue that he brings here. They fuel anxiety by pushing the investors to buy, sell on the trade button. So basically, that's kind of a precursor to what I just discussed, where the neuroscientists and the psychologists and the experts are pushing information to the media. The media is then spouting it. It's creating an emotional response in the average investor, and the rest is history. Then the investor panics and sells, or panics and buys at the highs and sells at the lows, and the cycle repeats itself. I mean, there's a bunch more here, but it was nice to see a good article posted, folks, going over what exactly is truly going on and what I've been trying to talk to you guys about since really the show started in the first Sunday of January. Okay, so let's get on to a couple other things, and just keep that in the back of your mind, is that this is the game that's being played. And if you're going to watch the financial news, be aware of it. That's all I ask. Be aware, and once you're aware, you'll be amazed how when, Guru XYZ is saying, oh, buy the markets, you're going to say, hey, wait a minute. Maybe this is the game. Maybe I shouldn't be just buying willy-nilly. Or when the Guru's saying, oh, my goodness, this market's collapsing, sell the market. Maybe at that point you're going to say, you know what? Maybe I won't sell the market, or maybe I'll buy the market here. And that's where you start to get freedom. All of a sudden you break free from these bonds that have been kind of clasping around you and keeping you down in the investing world. All right. In any case, I want to go into a couple other things. Let's first do the trade setups to make sure we get that in. So basically what I'm going to do, guys, is we unloaded 2 trades this past week, which have been big gainers for us, meaning the SGG and the CORN. And again, I just think those might just have a pullback for a week or so. So I want us at least to take the money, and then we can always buy it again on a pullback. And I actually do think there'll be good buys again. So maybe in a couple weeks we'll re-enter the CORN corn, which is the corn tracking ETF, and the SGG, which is the sugar ETF. But let's let them pull back. Let's let them create that price pattern time formation that I've come to you with today and started just to briefly discuss. And then we'll make that decision later on. All right. Number 1. We're still going to keep the Qs short, which we're going to keep the same price from last week, since we said we were going to give these a full 9 days instead of just 4 from last week. So 4 from last week, 5 from the coming week. So these will be closed out on the coming Friday, and we're going to use that price from last week, which was $89.81. The S&P short, we're going to use same thing, $1838.63. We're going to hold that one. And the VXX, which we're already in the money about $1 and change, but we're going to keep that one as well from $41.95. We're just going to hold that to the end of this coming Friday. All right, the 2 new trades that I'm going to give in, which are going to make it an even 5 for this coming week as well, are going to be IBB short, which is the biotech index. So basically, all the biotech stocks are rolled into an index, and it's a tracking index. The symbol for that is the IBB. And what we're going to do is we're going to short that. It's honestly, that's where the biggest bubble is in this market. If you look at the biotech stocks, they've gone out of control. Honestly, I can't even believe it's as high as it is. I've been bearish on them for some time, and it's honestly gone up and up and up. But I do believe that at this stage of the game, this next fall, you should see a very nice collapse on it. The last fall, funny thing is, in the last move down in late January, early February, this thing had a huge fall. Huge fall. I think it was about a 15+% fall. So it's ripe for a fall as it's at new all-time highs now. And on the next wave of selling, it really could get damaged pretty significantly, which would be good for us as shorts. Okay? The other one is Facebook. Facebook is on the short list here at a closing price from Friday at $68.59. And just to go back to IBB, that was $268.71 for you home gamers there that are tracking these. And again, IBB short at $268.71 and Facebook short at $68.59. Now, why Facebook short? Well, just last week they bought out WhatsApp for, I think it was $19 billion, something in that range. And I'm not saying that it's a bad acquisition. I'm just saying that where Facebook is after diluting their shareholder base by about 19 billion or so, that at this stage of the game, the stock has no reason to be up where it is. I mean, if you look at that chart, remember it was like an $18 stock not long ago. Now it's around $70. It's a $175 billion plus company at this stage. It's just due for a pullback. It's gotten extended. This buying of WhatsApp, no reason for the stock to actually have moved up on that. It did on the day it announced it and then pulled back on Friday. This will come down, in my opinion. I'm pretty confident based on PPT, price pattern, time formation. So look for Facebook to come back in the coming week, especially if the markets get a little bit on the weaker side. All right, so just to go over them one more time, folks, we have the Qs, all right, 89.81 short. S&P 500 short, 1838.63 is the price point on that. VXX, which is a volatility index. We're long on VXX from 41.95, and we're adding IBB short at 268.71 and Facebook short at 68.59. So you're seeing now I'm very heavily shaded towards the downside. And again, the risk reward to me, this is going back to risk reward. It's just a matter of looking at the markets and saying, all right, even if they peak above that high, which I don't think they will do, but even if they do, all right, so you got a 1, 2, 3% upside max, as opposed to downside, you got 10% correction downside possibility. So I'd much rather be facing that way and making money as the odds are favoring that highly, and there's just not much risk, in my opinion, to holding on the long side. It just isn't. Okay, and again, I'm only giving myself 5 more days here, but I still think that the markets are setting up based on the weak action in this past week, which most average investors would say was strong since the market held near its highs. I was looking between the lines, and I see weakness there. Okay? Just a couple of last things I want to go over. One trade setup that I thought was interesting on Friday as we come into the end of the show today, folks, or I should say last week the trade setup was. It was on Apple. All right, so Apple, guys, we saw this stock, and it popped up the past couple weeks, and I'm just bringing up the chart as I speak about this so I can really take a look. And basically what happened was, I don't know if you guys recall, but if we go back on the charts to the day they announced earnings, which was on the 27th of January, the stock had closed around the, let me get a price on that. Yeah, right around the 550 level, okay? And after earnings, we saw the stock selling off dramatically for a couple days, and then since the markets rallied up, the stock has come back up as well. And as the stock came back up, it came right back to that previous level of earnings at that 550 level, and then it sold off. So why did that happen? Well, and again, I don't have much time left here, but bottom line is this stock came back to where people were break even from prior to earnings, and all those people just said, I'll sell. And I'll touch base on this next episode next Sunday and go into a little bit more in depth, because you can actually use this to make significant money. All right, so again, folks, I'm going to say goodbye for now. My name, again, Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. Come join us, take the 7-day free trial. And this is In the Money Stock Market Action at 8:20 a.m. News Talk Radio. Take care.